Let's kick things off with a fundamental truth from Warren Buffett. It's a simple, almost brutal, piece of arithmetic that honestly explains more about building long-term wealth than 1,000 complex strategies ever could. It's about the quiet enemy in every portfolio: fees. So today, we're going to dive deep into one of the most important lessons in modern investing, and it was all proven by a decade-long million-dollar experiment. We're going to deconstruct the myth of complexity and show you with hard data why the most disciplined, patient, and boring approach is actually the most powerful way to build real, lasting wealth. Here's how we're going to break it all down. First, we'll look at the big question Wall Street really hopes you never ask. Then we'll examine the wager designed to answer it once and for all. We'll look at the cold, hard data from the result, deconstruct the myth of the genius stock picker himself, and then wrap up with this simple, actionable advice that came out of all of it. All right, Section 1, the billion-dollar question, or the allure of complexity. You see, to really get why this bet was so important, you first have to understand the story that the entire financial industry is built on, the one they sell you every single day. It's a really seductive story, isn't it? This idea that there are gurus out there, financial wizards with some secret formula who can outperform everyone else, for a hefty fee, of course. It's basically a get-rich-quick scheme dressed up in a fancy suit. But back in 2008, the world's most respected investor decided to put that entire narrative to a very public and very expensive test. And that brings us to Section 2, the ultimate wager, a clash of philosophies. Now, let's be clear, this wasn't a gamble. It was a clinical experiment designed from the ground up to test a single, powerful hypothesis over a full decade. The terms were incredibly simple. Could a passively managed, low-cost index fund, a fund that literally does nothing but own the 500 biggest U.S. companies, beat a portfolio of hedge funds handpicked by experts? This was a direct fight, passive simplicity versus active complexity. And the most important part, the results would be measured after all fees were taken out. This really is the classic story of the tortoise and the hare. On one side, you've got the S&P 500 index fund. That's the tortoise, slow, steady, systematic. It just plods along, owning the whole market, no drama. On the other side, you've got the hedge funds, the hares, darting all over the place, using complex, secret strategies driven by supposed experts and charging you enormous fees for the privilege. I think we all know how that fable ends. So, after 10 long years, a period that included one of the worst financial crashes in history and then a massive bull market, the results came in. And they weren't just clear. Honestly, they were devastating for the high-fee crowd. The data just speaks for itself. This simple, boring index fund delivered a total gain of over 125%. The best-performing group of hedge funds didn't even come close, at just under 88%. And look at the worst one, barely 20% over an entire decade. In fact, the hedge fund manager conceded defeat years before the bet was even over. The math was just too brutal to ignore. If you look at it on an annual basis, you can really see the power of compounding at work. The index fund compounded at 8.5% a year. The hedge funds, on average, just 2.2%. That's not a small gap, that's an absolute chasm. Over a lifetime of investing, a difference like that is the difference between a comfortable retirement and constantly worrying about money. So what caused this massive gap? This, right here, this is the enemy. Isolated on one slide. The index fund cost about 0.04% per year. Basically, nothing. The hedge funds, on the other hand, charged layered fees, often the classic 2 and 20. That's a 2% management fee every single year, plus 20% of any profits they make. That's the corrosive drag Buffett was talking about. Performance might come and go, but you can be sure those fees, they never falter. All right, Section 4, deconstructing the oracle, the twist in the tale. But hold on, the lesson here isn't just don't buy high-fee funds. The story actually goes a lot deeper. And to find the ultimate lesson, we need to turn the statistical lens on Buffett himself. So you might be asking, if active management is so flawed, how do you explain Buffett? He's the greatest active manager of all time, right? Well, the answer to that question challenges the very idea of a stock-picking genius, and it actually validates the boring, passive approach in a way that's even more powerful than the bet itself. Think of Buffett's career as a two-act play. In Act 1, from the early 80s to the early 2000s, he was an absolute legend. His outperformance, what we call alpha, was so consistent it was statistically proven to be skill, not just luck. But then, in Act 2, For the last 20 years or so, something profound changed. His measurable skill, his alpha, it just vanished. Just look at the hard data. In Act 1, his annual alpha was almost 17%. The T statistic, which is just a fancy way of measuring skill versus luck, was over 3, well above the threshold for genuine skill. But in Act 2, his alpha collapsed to almost nothing, and the T-stat fell to a number that's statistically indistinguishable from random chance. The magic was gone. But was it ever really magic to begin with? You see, when academics deconstructed his early performance, they found it wasn't some mystical ability to see the future. It was a disciplined, systematic process. He was just systematically buying quality companies at low prices. These are factors we can all access now. He had cheap leverage from his insurance businesses, a huge advantage nobody else has. And he did it all with an iron will in markets that were way less efficient than they are today. He wasn't a magician, he was the master of a system. And that brings us to the most important point of this entire discussion. Buffett's real genius was in recognizing these systematic drivers of return decades before anyone else. But today, you don't need to be a genius. You can buy those exact same factors, value, quality, low volatility, through cheap index funds. So if the greatest active investor's own career proves that a systematic, rules-based approach is what works, well, the case for paying someone high fees to be a guru just completely collapses. Which brings us to our final section, the master's final advice, the blueprint for success. Based on his own bet and the statistical reality of his own legendary career, Buffett has laid out a remarkably simple blueprint that works for almost everyone. This is it. This is the instruction he literally left in his will for the trustee managing his own wife's inheritance. Not his own company's stock, not a complex portfolio of active funds, just 90% in a simple, dirt-cheap S&P 500 index fund and 10% in bonds. It is the ultimate expression of boring is brilliant. It's a strategy built not on hype or hope, but on the brutal, beautiful arithmetic of low costs and long-term compounding. And so that really leaves us with a final question for you to think about. When you look at your own strategy, what are you really buying? Are you buying into a disciplined, evidence-based system, like planting a seed and having the patience to let it grow? Or are you just paying for complexity, for a good story, for the noise of someone promising to beat the market? The mathematical evidence is clear. The choice is yours.